Great, welcome. I call this meeting to order. This hearing, entitled Problem Credit Card Practices Affecting Students, focuses on the issues that arise in the context of credit card marketing to students, especially college students, and I welcome the witnesses and thank them very much for being here in their testimony. This hearing is the outgrowth of response to our comprehensive credit card reform bill, the Credit Card Holders' Bill of Rights. At our roundtable last year and in later discussions, it became clear that many issuers, consumer advocates, and members share a special concern with students' use of credit cards. As a new entrance to credit, students seem particularly vulnerable. As some of you will recall, in the late 90s, credit card marketing on campuses became the subject of press reports and controversy. At the request of Congresswoman Louise Slaughter, Congressman John Duncan, and Congressman Ken Jaworski, the GAO undertook a study of college students and credit cards issued in June of 2001. And I'd like to take this opportunity with unanimous consent to enter into the record Congresswoman Slaughter's testimony. The GAO concluded that while credit cards offered students many advantages, there were grounds for concern that college students were more likely than other credit card users to end up with high debts. As the GAO report found, credit card issuers market intensively to college students. This is not surprising. Students represent new customers who live bunched together and are thus cost-effective to reach. Students want and often need credit, but may not realize all the consequences of applying for or getting a credit card. In some cases, schools facilitated the issuer's efforts to market cards to students. In his 2000 book, Credit Card Nation, Professor Manning of the University of Rochester documented arrangements between universities and colleges and issuers under which the schools received money from the issuers for the right to market credit cards on campus to the students. Manning found that these agreements resulted in payments to the 300 largest universities of some $1 billion. About 18 states have since passed laws restricting or regulating on-campus marketing by issuers. In addition, many schools have banned on-campus marketing. But the issue is not resolved. This spring, New York Attorney General Andrew Cuomo announced that his office was conducting a nationwide investigation into whether credit card marketers offered payments or other incentives to colleges in exchange for exclusive access to the institution's students. Marketing to students often involves offering a reward for applying for a card. In March 2008 survey, USPIRG listed T-shirts, food, sports, toys, caps, mugs, and sodas as commonly offered gifts. 7 years after the GAO report, major issuers have introduced a number of important policy changes to address the special problems of students and credit cards. For example, American Express says that their Blue for Students card has more stringent limits on the size of credit lines than the normal Blue card, and that they do not actively market to students on campus or otherwise. Citi's Platinum Select card was acknowledged by Consumer Action for rewarding students based on responsible credit behavior and was a top pick for best student credit cards as reported in smartmoney.com in August. Bank of America says it caps students' available credit at $2,500 and does not raise students' interest rates retroactively for any reason. I applaud these and similar efforts, which represent best practices consistent with the gold standard principles for voluntary action that resulted from the roundtable on credit cards I convened last year. But the question is, are voluntary efforts enough? Will the force of competition drive those who want to move to best practices back to doing less? And ultimately, what is the best way to ensure that students become responsible users of credit? In fact, studies since the GAO report show that credit card debt held by students is rising. Using data from the Federal Reserve Survey of Consumer Finance from 2004 and 1989, the nonpartisan organization Demos calculated that young adults between 18 and 24 have 22% higher credit card debt than their peers had in 1989. Similarly, studies conducted by Nellie May show a significant rise in credit card usage among students. A 2005 report done by Nellie May of students in college found that 76% of undergraduates had a credit card as opposed to 67% in 1998, that 43% have 4 or more cards as opposed to 27% in 1998, and that the average balance on student credit cards was over $2,000, up from $1,800 in 1998. Perhaps of most concern, students' use of credit cards to pay for tuition is also going up, even though federal student loans are generally available at lower rates and on more flexible repayment terms. In the 2001 GAO study, about 12% of undergrads said that they used credit cards to pay for tuition. The 2005 Nellie May Credit Report study showed that figure doubling. 24% of undergrads used credit cards to pay tuition. These are the issues we will be looking at. I look forward to the testimony. And I yield to Mrs. Biggert for as much time as she may consume.
Thank you, Madam Chair, for holding this hearing to address credit card practices affecting students. I'm glad that today we will recognize the success story of students' access to credit. On the other hand, I'm also pleased that we'll be looking into problems that some students have, ranging from selecting the right credit card to difficulty managing their credit or a budget for that matter. Of course, another related issue, but for another day and another committee, is how the College Cost Reduction Act has caused the student loan market to dry up. This fall, more students may find their credit card a financial life preserver unless we fix some of the provisions of that other bill. But today it's important that we look into any collusive activity among colleges and universities or their employees and credit card companies. Some disturbing studies indicate that such activities have led to unfair marketing practices and reduced card competition on campuses. Institutions of higher education should be safe harbor for students to learn and to grow. This should include educating students about credit, how to use it, and most importantly, how to use it responsibly. Like advisors that steer students away from the wrong class, I think it's important that students are advised on matters of finance and steered away from the wrong financial product, whether it be a credit card, a student loan, or other line of credit. It's important that we help students as well as all young people understand the importance of establishing credit and a good credit record at a young age. It's the financial foundation on which they will build their future. Unfortunately, starting off on the wrong foot seems to be a trend among some college students who first look at the free apparel or a t-shirt or a coupon for free food before looking at the interest rate or payment terms of a credit card. And that's a problem. Students need to understand that there is no such thing as a free lunch. We know that the U.S. Financial literacy rates are low. Courses in personal finance and economics are not a top priority compared to English, math, science, and history. That's a problem too. Personal finance and economics should be a top priority for colleges and universities, technical schools, secondary schools, students, student governments, and organizations, and some would argue for members of Congress as well. I don't think my colleagues would disagree with me when I say that some members could use a little Econ 101, but I digress. The government, colleges and universities, credit card companies, and our students need to work together to strike the right balance between consumer education and fair and transparent credit card marketing. How we accomplish that goal through legislation, regulation, competition, private sector innovation, financial education, or a combination of these is what brings us here today. I believe that today's witnesses will reveal how financial education can and should play one of the biggest roles in this effort. My goal is to promote financial education on college campuses so that students are armed with the financial tools that they need to use credit wisely while not cutting off students' access to credit. College students have greater access to credit, access to cheaper credit, and access to financial education today than ever before. So I hope that no action Congress takes will reverse that positive trend. With that, I look forward to hearing from today's witnesses and yield back the balance of my time.
Thank you, and I yield 4 minutes to Congressman Cleaver, who has his own bill in on this very important subject.
Thank you, Madam Chair, and I would like to express appreciation to you for all of the work that you've done on this issue, and I am very much appreciative of the opportunity to participate in this hearing. The impact of credit cards on the lives of minors and students is a particular focus of mine, and I'm pleased that we're coming together today for the opportunity to discuss it. In March of '07, Congressman Udall and I introduced H.R. 1461, the Credit Card Accountability, Responsibility, and Disclosure Act of 2007. This legislation, important as far as we were concerned, included a provision which enumerated the responsibilities which credit card issuers must undertake in order to issue credit cards to minors. And I believe that this is extremely important because we as a nation cannot allow young people to go into the kinds of debt that they are experiencing, because I can foresee a similar problem with credit cards that we've had with subprime loans. I'll talk more about that as we go along. I read in my hometown newspaper, the Kansas City Star, that according to the April 9th Jumpstart survey, high school seniors correctly answered just under 1/2 of the questions on a financial literacy test. And this shows that minors are not getting enough financial literacy education, and thus giving them credit cards without the kinds of knowledge that they need is, I think, doing a great disservice to them. And, you know, what we are saying is that they must have a steady and substantial income with which to pay off their credit card debt if they are issued a credit card debt. And of course, if a minor is legally emancipated, he or she only has to prove that they can, in fact, pay their credit card debt. Now, I want to get into some serious discussion with our panelists, and I appreciate them coming. I need to add one other, I think, important fact. From one perspective, I think that it is reasonable and we are somewhat justifiable in saying that college students who work have an opportunity to get credit cards. I think that it's important to understand that 55% of students report that they work part-time in college. 45% of the students who are in college today do not work at all. And credit card issuers must disclose the terms of an agreement, and they all who are represented here today will say they do that. But according to the 2006 GAO report, increased complexity in rates and fees heighten need for more effective disclosure to consumers. Some of these statements are written in a 27th grade language. And so let's take for a moment, if I graduate from elementary school, middle school, high school, get a BA degree, go to seminary, and then come out and get a PhD, I will still have at least 3 years to go before I reach the 27th grade. And we are saying that these college students, many of them 18, 19 years old, ought to be given credit cards. I think that this is a step in the wrong direction. Many of these students are going to get out of college, end up in the same situation with the subprime individuals, and they're going to find that they cannot pay their debts. It is a tragedy waiting to happen. I've seen it happen in my own family with my own son, who has no business with a credit card. He barely has business with cash, and one of this, and I think it is doing enormous damage for us to come to the conclusion that we can just send out credit cards because college students may be in the higher income levels of society. I think it's wrong, and I think we've got to put some stops to it today. I appreciate it and yield back the balance of my time.
Chair recognizes Mr. Henseling for 5 minutes.
Thank you, Madam Chair. As I look upon the title of today's hearing, Problem Credit Card Practices Affecting Students, I'm just curious if I will see a hearing one day, Solution Credit Card Practices Affecting Students. Because as I observe the market, the ability of students to have access to credit cards creates a whole lot more solutions than it does problems. Now, I assume through this hearing that we will hear genuinely sad tales of lives that have been significantly harmed by abuse of credit cards. I assume these tales will be true. I assume they will be sad, and I assume we should pay very careful attention to them. But I'm also curious during this hearing whether or not we will hear tales of students who, but for access to a credit card, could not pay their tuition, but for access to a credit card, could not pay for their books, but for access to a credit card, they couldn't pay for their room or board, but for access to a credit card, they couldn't fly home during the holidays, and the list goes on and on. I have no idea why, but when I was a sophomore at Texas A&M University, some credit card company decided that I was worthy of a credit card. They sent me a mail solicitation. I didn't seek the card. They sent it to me, and I was glad to receive it. By no stretch of the imagination do I come from a poor family, but I didn't come from a rich family either, and I worked my way through school, bussing tables, working on a loading dock, being a night clerk. And my ability to have that credit card several times helped me with automobile repairs on a very decrepit 1965 Ford Mustang. And I wonder, but for that credit card, I wouldn't have been able to afford those repairs. But for those repairs, would I have been able to go to work? Had I not been able to go to work, could I have completed my college degree? I've got one testimonial for the fact that at least this particular individual was very happy to receive a credit card, and it served a very useful purpose in my educational life. Now, whatever the perceived or real illness in the student credit card market may be, I fear that any cure from this committee may prove worse than the illness. Having said that, though, I am, with some interest, interested in viewing further the details of the gentleman from Missouri's bill, and particularly if it deals with credit card issuance to minors. I think it would be very, very worthy of serious contemplation and consideration by this committee, and I'm always happy to surprise my friend from Missouri and occasionally say nice things about his legislation. But again, I think we must remember that every restriction, every limit, every regulation has a high probability of making credit less accessible, less affordable, more costly, ultimately helping rob people of their educational opportunities, especially at a time of skyrocketing tuition when we know that the student loan market is in full retrenchment. I would hope this committee would not consider any legislation where the cure is going to prove worse than the illness and rob thousands, tens of thousands perhaps, of their educational opportunities. And as an aside, let's remember, with very few exceptions, the people in college are legal adults. They can vote, they can contract, they can marry, they can serve this nation in uniform. And are we going to deny them their basic freedom, their freedom of economic opportunity to own a credit card? And I've seen at least one study, as another aside, that showed that students pay off their credit card bills on time 65% of the time, which is better than the adult population as a whole. Now, again, I have no doubt that there are abuses in the market by credit card companies. I don't doubt that. I don't doubt that many students do not use credit responsibly. But maybe the solution would be greater financial literacy. Maybe the solution would be more effective disclosure. Maybe part of the solution is personal responsibility, and maybe part of the solution is even increased enforcement of our anti-fraud and deceptive trade practices law. And I suspect that would prove to be far, far more beneficial to our student population than anything else that would deny them access to credit cards, make it less available, more expensive, and help deny them their educational opportunities. And with that, Madam Chairman, I yield back.
The chair recognizes Congressman Scott for 3 minutes.
Thank you, Mr. Chairman. I really appreciate this timely hearing. This issue is very, very important. It's not it's a problem for the entire nation. It's not just a personal financial area issue. Household debt has ballooned from $59 billion in 1980 to today. It's up to $830 billion as of 2006. And this is just this statistic alone certainly recognizes the importance and the gravity of the issue. And nowhere is it more important for us to rein in the abuses of credit cards than with our young people, and especially they are a targeted group. Now, there are some in the credit card industry that are doing some beneficial things in correcting this. I want to single out, for example, Morgan Chase and Citigroup, as we all know, have incorporated some, made some changes to their business practices, and they should be commended. But there are far too many deceptive practices that are going on. And, but I'd like to just address one important thing about what we can do, because no matter what the industry does, the issue finally boils down to that individual taking responsibility for his or her own decisions. And we've got to help that. We've got to help our college students to be able to understand the responsibility on their part. That credit card is sort of like a rope that's given to a man to pull himself up. He can either use that rope to pull himself up, or he can use that rope to hang himself. It's up to that individual. And in so many cases, our college students are using this credit card or rope to cause damage to themselves. So maybe we can focus on a few things. For example, why not bring the parents into this? We're looking at kids who are 16, 17, 18, 19 years old. They're just at the start of their lives. They don't have the gravity of experience that older people do. I think that might be an example. Parents have got to become more proactive in their students' lives and their children's lives as far as talking to them about money and explain the pitfalls of financial debt and consequences. For every action, there's a consequence to that. We need to see if there are any programs that we can come up with that can be available, which parents can utilize to this end. In the final analysis, oftentimes it's the parents that got to bail them out and pay these bills. So it makes sense. Are there any specific classes that are going on the college campuses themselves that relate to financial literacy? Financial literacy and education is the area that we're not paying enough attention to. And if you are financially literate, if the students are geared, and the parents, to read the fine print, to know what you're getting into before you sign up to these cards. It's not just a card there to get. I think that this is very important, Madam Chairman. Thank you very much for the opportunity, and we'll get into some of this as we move forward.
Thank you very much. And our last speaker is Congressman Castle for 5 minutes.
Thank you, Madam Chairwoman. In preparation for this hearing, I talked to some of the folks on my staff who attended college more recently than I. They all attended college more recently than I did, but I only spoke to a few of them, about their overall understanding of credit cards. Each of them knew that credit cards are not free money, but that indeed anything bought with a card would have to be repaid. These individuals were taught by their parents or others while in high school about the importance of being responsible with credit. However, some statistics have suggested that 18-year-olds are more likely to take on more credit card debt than adults over age 22. We cannot make these new credit card users utilize credit more wisely, but I strongly believe that an education in consumer choices would greatly benefit students and help reduce the incidence for irresponsible use of credit cards. I would like to emphasize that credit cards, when used responsibly, can be beneficial to younger adults. For most students, buying books and supplies for one semester can cost more than $500. In addition, some students may have their hearts set on graduate school, and building credit through use of credit cards could expand their choices when applying for student loans. Just like you and me, students may encounter unexpected expenses, car maintenance for commuters, an airplane ticket home to visit relatives, or even a trip to the emergency room for a school athlete. Unlike students, most of us could pay for these expenses immediately because we have full-time jobs that provide us with a steady income. Students, on the other hand, could benefit from having extra time to make a payment through the use of a credit card, while at the same time building a credit history for their future. With that, I look forward to hearing the testimony of the panel before us, and in particular, I commend Mr. Thurman for his efforts in increasing awareness among his peers with regard to student debt in the face of the rising costs of college education. I yield back, Madam Chairwoman.
Thank you very much. We are fortunate today to have 6 witnesses, and we will begin with Benjamin Lawsky, Deputy Counselor and Special Assistant to Attorney General Cuomo, Ms. Christine Lindstrom, Director of the Higher Education Department, Project of USPIRG, Brent Thurman, undergraduate student and president at the University of Illinois at Chicago, Kenneth Clayton, Managing Director and General Counsel, American Bankers Association, Card Policy Council, Ms. Erika Williams, Policy and Advocacy Manager from Campus Progress, and Brent Neiser, Director of Strategic Programs and Alliances from the National Endowment for Financial Education. Without objection, your written testimony will be made part of the record. You will each be recognized for a 5-minute summary of your testimony. And I now recognize Mr. Lawsky, and we'll go right down the row. 5 minutes.
Thank you very much, Congresswoman, Chairwoman. I really appreciate your having us here today. Attorney General Cuomo would have loved to have been here. We had a large narcotics takedown scheduled for today, and he couldn't make it. He's up back in the state. Let me start by saying I am not an expert like other members of this panel probably are in the credit card industry. What I can do is tell you about the investigation we have ongoing to some extent, and I want to add one other caveat, which is because our investigation of the credit card industry is ongoing, there are certain things, unfortunately, I can't fully get into, and I may have to defer on certain questions you ask. With that said, in 2007, Attorney General Cuomo began a large-scale nationwide investigation of the student loan industry, as you alluded to in your opening statement. And that investigation indicated, and what we found was that lenders around the country were paying off schools basically to become the recommended lenders at the universities. They were basically paying to become the recommended lender to the students. It was enormously lucrative to the lenders, and it was also at times lucrative to the schools. We settled quite a few of those cases. Most of the schools and the lenders agreed to stop the practices. But ultimately what we did was we sponsored legislation, first in Albany, and then with the help of our friends here in Washington, a bill is now pending. It's in the Higher Education Act, and hopefully will pass relatively soon, the Student Loan Sunshine Act, which will ban these practices across the country. But what our investigation of the student loan market indicated to us that's relevant for today is really 2 things. One is student debt in this country is enormous. And second, what we realized was the use of the university by businesses as a bottleneck to get access to students through relationships with business officers at schools was something that wasn't just limited to the student loan industry. We started looking in other areas, and we found it with textbooks, we found it with computers, we found it with health care plans for students, we found it in the food service industry, and maybe most disturbingly, we found it in the credit card industry as well. So we have investigations going on in all those areas, but with respect to the credit card industry, what we found was, and what we are continuing to find, is at a very, very large number of universities around the country, there are highly lucrative, somewhat secret, exclusive marketing agreements at the schools with particular credit card companies. The schools have, in many cases, agreed not to make these agreements public to anyone. Fortunately for us, because we have a little something called the subpoena, we've been able to obtain at least many of those agreements, and we've been able to really analyze many of the provisions in them. And I think when those provisions in these agreements become public sometime relatively soon, I think it will shock many people, the kind of relationships that some of these credit card companies have with the schools. These deals usually give very significant marketing rights to the credit card companies at the universities. Often, for example, there'll be a provision that says you get to, the university will provide the student the list of all student data. So you get the students' email addresses, you get their home addresses, you get their school addresses, you get their phone numbers, and you can market to them by phone 3 times a year and by mail 4 times a year. And in return, we're going to get paid, the school, $1–2 million a year. The marketing practices that then go on at the universities, which I'm sure my colleagues will talk about in greater detail, are extremely aggressive. They often involve giving away free goods to entice students to sign up for cards, and they often involve using students to recruit more students, actually using peer pressure to get more students to sign up for cards. We are most focused right now, though, on the what are called sometimes affinity arrangements, which is where the schools allow, in the agreements, they're getting paid basically to allow the credit card companies to co-brand and market their cards, for example, as the Georgetown card or the Harvard card or the Yale card. And that's very similar to what we found in the student loan investigation, where there was a payment to the schools to allow, and the school, in return for that payment, we're basically representing to students, this is our preferred lender. Here it's, this is our preferred credit card. And students, of course, trust their alma mater. They trust their schools. And it is enormously powerful, and the groups know this. And we are busy investigating that relationship very closely, and obviously we'll continue to do so. I see I'm out of time, but I'll just say, absolutely, we certainly stand ready, as we did in the student loan industry, as our investigation proceeds. To the extent there is a systemic solution that works, it probably makes sense ultimately for that solution to come from a legislative body, and we are certainly stand ready to help in any effort here to do that. Thank you.
Ms. Lindstrom for 5 minutes.
Good afternoon. Thank you for the invitation to address the issue of credit cards on campus. My name is Christine Lindstrom, and I am the Higher Education Program Director for USPIRG. I work with college students on campuses across the country to make sure that college stays affordable and accessible. Our data suggests that credit card debt among college students is growing. We've also documented that excessive high-cost credit card debt has exacerbated the crisis that students already face from the rising costs of higher education. Our project has focused on several areas where educational costs have skyrocketed. We've mentioned some of them. Basically, as states have pulled back on funding for public higher education, more of the cost of college has fallen on the shoulders of college students. Now, students are increasingly burdened with educational debt, which can cause them, once they graduate, to opt out of lower-paying but socially valuable careers like teaching. In addition, textbook costs, as well as other ancillary educational costs, continue to increase. And as a result, students have become more reliant on their newly acquired lines of credit to help offset these costs. From that vantage point, last fall, we launched the Truth About Credit campaign on college campuses across the country. The project has 2 goals. First, we're educating students about being good credit card consumers through a counter-marketing campaign that we call FEESA, F-E-E-S-A. It has a tagline stating, "Free gifts now, huge debt later." We're actually dressed up like credit card marketers on the campus, complete with polo shirts, and we're able to educate students about being able to navigate the marketplace. We've literally passed out thousands of these booklets, the Consumer's Guide to Credit Cards, on hundreds of campuses across the country, and requests roll in every day from campus administrators to be able to use these guides in orientation and to help with their education efforts. Second, we're working with student governments and administrators to establish principles on campus that rein in aggressive credit card marketing on the campus marketplace. As part of this effort, last fall, we conducted a major survey and released the results in March, and that is a report called the Campus Credit Card Trap. You've seen some of the detailed results of the survey in my written testimony that I submitted. What we did find is that indeed college students are a target market for the industry. Students are literally inundated with marketing tactics from credit card issuers, with high numbers of them reporting regular telephone solicitations, and 80% of the participants reporting that they received mail solicitations. Some reported hundreds, but on average we found that students got about 5 solicitations a month from credit card issuers. And of course, they're regularly enticed into applying for credit cards at tables on campus through the offer of free gifts like pizza, candy, t-shirts, beach chairs, and in one instance we found iPods being raffled off for credit card applications on campus. Our survey also found that indeed students are using their credit cards to offset educational costs. A full 55% of participants had paid for textbooks on their credit cards. And our other studies show that students pay on average $900 a year for textbooks. 55% of participants report putting day-to-day expenses on their credit card, including gas and public transportation costs to get back and forth to school. And as noted, 24% of our survey participants also reported putting tuition on their credit cards. Additionally, a significant number of participants had gone over the limit on their cards and had lost a card already as a result. Students in the survey supported our principles for responsible credit card marketing, including policy to stop sharing their names with the credit card industry, a policy that would promote a fair card with better terms and conditions to be available for application on the campus, and a policy that banned the use of free gifts, which so often obscure students' abilities to be good consumers when considering whether or not to apply. USPIRG has looked at a number of pieces of legislation addressing the issue of credit card marketing. We believe that the best marketing solutions can be implemented on a campus-by-campus basis. However, we support legislation that would give students the ability to choose if they would like to have their names to be sold to credit card issuers for marketing purposes. We also support a variety of legislative proposals that attempt to ban or control some of the more unscrupulous terms and conditions contained in credit card contracts. I'd like to make a final point that we do not think that college students should be banned from being able to access or use a credit card. Instead, we think that college students should be treated just like every other consumer in America, with no special rights or privileges, and be able to apply for and get credit according to the same standards as everybody else. Currently, underwriting standards are generally waived for college students, so they meet no income or credit background criteria in order to qualify for credit. Such lax standards have created a campus marketplace in which students are unfairly marketed to, taken advantage of with bad terms and conditions, and plunged deeper into debt. Thank you for your time.
Thank you very much. I don't have the statistics that some of my colleagues here at this table have. Instead, what I have for you is a story, and I'd like to thank you very much for taking the time to listen to a student, and I'd like to ask your patience with me, as the story is just very blunt, very point of fact, and not with any statistics to back up. I rely upon my colleagues here for that. I attend school at the University of Illinois at Chicago. Our university has very strict policies about credit card companies not being allowed on campus to offer any kind of information, to offer any kind of solicitation, or offer any kind of prizes or free food to our students. As a response to this, I have noticed both in my freshman and sophomore years, this would be 2005 and 2006, that you will encounter a student or someone who appears to be a student on campus, and they will give you a piece of paper, and that piece of paper will say, Subway, free sub sandwich, Monday through Friday, 1 p.m. to 5 p.m., for example, just this week only, and this will be in the first 2 weeks of school. The Subway is exactly 1,020 feet away from the nearest university building. I went ahead and pasted off earlier this week. You go to the Subway, you hand a piece of paper to the cashier, and he tells you it's not really a coupon, you need to see the gentleman in the corner. You go to see the gentleman in the corner, and he has for you a form to fill out. It's an application for a Discover card. At this point, I really don't have a problem with what's happened so far. I understand that it's a marketing technique. I understand that some people would consider it a little shady. But I'm a student of political science. I'm a student of the markets. And I'm fine with people trying to find ways around and try and find ways to pursue their market advantage. Here's the problem I have. I walk up to this gentleman and I ask him, how is this going to negatively affect my credit? My parents told me about stuff like credit reports before. Is this going to show up? The response I get is, no, you don't even have to accept the card. All you do is wait till it comes to the mail and just throw it away. You don't have to call and accept it. No one tells me there's going to be a mark on my credit saying that I was inquired about. Well, what if I really don't want a card at all? Can I still get a sandwich? I get a response, well, you need to fill out the form, but don't worry, you can just throw out the card. You're really not even applying for a card. You're just giving us your information so that we can see if we can offer you a card, which, if you write that down on paper, seems kind of contradictory. These are the things I have a problem with. This happened for 2 years at the Subway restaurant with Discover. At first, I thought the problem had been solved or it had gone away after a U.S. News & World Report had actually interviewed one of my roommates who got a card in this manner. Then, just a few months ago, end of April, early May, I'm walking down the same street, and a friend of mine comes up to me and says, hey, Jimmy John's giving away free sandwiches. I got this slip from someone on campus. Jimmy John's is across the street from Subway. So I went ahead and went into Jimmy John's, and there's a bank of 4 or 5 laptops set up. And so I asked the exact same questions. And now it's not for Discover card. It's for a Chase. I forget if it was MasterCard or Visa. And I ask the same questions, and I get the same vague responses. I get the same misleading responses. And that's the part that really upsets me. And that's what I really have for you is our story from UIC. We're an urban college. We have 16,000 undergraduate students. If I had to take a guess, I'd say at least 12,000 of us have credit cards. And with that said, I wish Mr. Hensling were still here so I could thank him. I would like to take this opportunity to point out that credit cards are an extremely useful tool for students. If not for credit cards, but for access to a credit card, many of our students couldn't pay for things such as the summer term of school, which doesn't have much federal or scholarship or grant funding available. Many of our students couldn't pay for things such as raising room and board rates, raising student fees, and extraordinarily high cost of college textbooks. I would also like to point out that but for access to a credit card, those same students would not have a 19% interest rate to pay off, while 45% of our students don't even have jobs while they're in college. But for access to a credit card, those students will not face higher credit payments for less money advanced to them than they would on most student loans, even commercial student loans. I'd like to take this opportunity to bring everyone's attention to the fact that this isn't just a credit card problem. This isn't just a student problem. This is brought about very specifically because students need to find more financing for education. And this financing is not available in the places we would like it to be available. So this is a problem that must be faced on many fronts. But when we start talking specifically about credit cards, I would wonder, where's the business model? What is a credit card CEO thinking extending me a credit card when I tell him I have $0 annual income? $0 annual income. Where are they anticipating the revenue to come from? I can only surmise that they anticipate the revenue to come from a very high interest rate spread across a very long period of time, which will be the period of time until which I graduate. And then when I graduate and I look at my possible career possibilities, I'm going to wonder, well, I could go into social work. I could be a public high school teacher. I could start at $35,000 a year, and I could spend 15 years paying off my student loans and my credit card debt. Or I could start in the corporate world at $50,000 a year and get this paid off and get this monkey off my back as fast as possible. Thank you very much for your time.
Thank you for your testimony. Kenneth Clayton.
Chairwoman Maloney, Ranking Member Biggert, and members of the subcommittee. My name is Kenneth J Clayton, Senior Vice President and General Counsel of the American Bankers Association Card Policy Council. group within the ABA that deals with card issues. We appreciate the opportunity to appear today to discuss college students' rights as adults to obtain and use credit cards. We certainly acknowledge that not all students will manage debt in a responsible way, just as not all adults in general will manage debt without experiencing problems. Dealing with debt problems at any age can be very stressful, and banks do their best to deal with each individual situation quickly to help resolve the problem at hand. However, anecdotes of student problems in the card area fail to paint the real picture that students, as a broader group, are in fact managing their credit obligations well. Importantly, we fear that policy decisions made on the basis of anecdotes will result in the creation of barriers to credit access that restrict the ability of young, responsible adults to manage their everyday lives. In my testimony today, I would like to make 4 points. First, credit cards provide invaluable benefits to the adult student population. They offer an ability to meet day-to-day needs, from buying books to purchasing airline tickets, in an enormously convenient and safe fashion. They provide an unparalleled safety net for emergencies, and they provide an entry point to the world of credit, allowing students to build financial skills and a credit history that will one day permit them to buy a house, get a job, and otherwise participate productively in everyday life. Second, as a general matter, the bulk of college students handle their credit card experiences very responsibly. According to a 2008 survey by Student Monitor, 65% of student card users pay their balances back in full monthly. And for the 35% that carry balances, those balances average out at a mere $452. These numbers show, as do similar results from previous studies, that students handle credit as well as, and in some cases better than, the general adult population. They are also a reflection of the sound underwriting practices employed by banks, which typically involve imposing lower available credit limits, closer monitoring, and other safeguards on these accounts that result in limiting risk to both the student and the institution. Certainly, there are examples of students who took on more debt than they were ultimately able to manage. But in the vast majority of cases, students are acting responsibly and meeting their obligations. Banks have a vested interest in ensuring that the student's experience is a positive one, as the bank wants to build a productive, lifelong customer relationship that benefits both parties. Third, we believe that prescriptive policy decisions in this area may create barriers to credit that actually harm responsible young adults. Congress and several state legislatures have introduced legislation that would have the effect of limiting or preventing categories of college students from obtaining a credit card, whether through arbitrary limits on available credit or various prerequisites to credit card access. Today's student population is very diverse, and such barriers may impede large numbers of responsible individuals from the enormous day-to-day and emergency benefits that cards have to offer. And finally, we believe that the key to responsible card use lies not in artificial constraints, but in improvements in financial education. Most banks that issue credit cards are engaged in a wide variety of financial literacy and school education efforts, often in partnership with consumer groups, and many of these programs include training for young people using credit for the first time. ABA has cataloged on our website many of the efforts of our member institutions and broader groups to provide financial education to consumers, and I have provided a link to that site in my written testimony. Much needs to be done in this area, including improving educational efforts from grades K through 12. In conclusion, credit cards provide enormous value to young adults, the vast majority of whom have consistently shown that they can manage this product responsibly. We believe that continued efforts to improve financial education, rather than prescriptive policy decisions, are the best way to benefit this segment of the adult population. Thank you for considering our views, and I'll be happy to respond to your questions.
Thank you very much. And Erika Williams, Policy and Advocacy Manager from Campus Progress. Thank you.
Thank you, Chairwoman Maloney, Ranking Member Biggert, and members of the subcommittee. I'm Erika Williams, the Policy and Advocacy Manager of Campus Progress Action. We are part of the Center for American Progress Action Fund, and along with our sister organization, Campus Progress, we work very simply to help young people make their voices heard on issues that matter. First, let me thank you for the opportunity to testify on behalf of the young people on over 500 campuses and communities with whom we work. My testimony this afternoon will reinforce the points of several of our witnesses today, and will also seek to convince you of two things. First, that young people, especially students, are uniquely impacted by credit card debt and the abusive practices of credit card companies. Second, that this negative impact can be made better through an approach with legislative action at its center. Compared to previous generations, today's young adults have not only been forced to borrow for their education, but also for their expenses while in college. As we heard earlier, according to Nellie Mae, the average undergraduate has over $2,000 in credit card debt. We hear hundreds of stories, and here are the anecdotes we referenced earlier, and we know that there are thousands like that of Callie, a graduate of the University of Virginia. She shared with Campus Progress her experience with credit cards in college. When asked about the presence of companies on campus, she said, quote, "They were everywhere, like vultures, outside of my dorm, at football games, and in the quad. I took their teddy bears, free pizza, and complicated, convoluted sign-up forms." By her junior year, Callie had opened 3 credit cards, all on campus, and had incurred nearly $3,000 in debt. Along with the giveaways and incentives, she took high fees, heavy interest rate burdens, and complex terms, 3 credit card practices that have been proven to heighten the risk of default, and default she did. As a senior, she graduated with over $5,000 in credit card debt. Now, here are the points that we're emphasizing today. Callie's story is but one of many that we continue to hear from students and illustrates the key challenges that college students face with regard to credit cards. First, aggressive marketing and targeting by credit card companies on campus. They use a variety of techniques, from buying lists from schools and entering into exclusive marketing arrangements with universities, to marketing directly to students through the mail, over the phone, on bulletin boards, and through on-campus and near-campus tabling facilitated by so-called free gifts. The second challenge is high fees, heavy interest rates, and complex terms. But credit cards are notorious, and credit companies are notorious for aggressive marketing and fine print. So why is this situation particularly damaging for students? Because young people are in the most vital and vulnerable point of their financial lives. For college students, major borrowing from credit card companies is like visiting a Las Vegas casino. It's a gamble, and the odds are against you. According to a 2004 study by Nellie Mae, 76% of undergraduates have credit cards. 1/4 of the students surveyed in USPIRG's 2008 report said that they have paid a late fee, and 15% have paid an over-the-limit fee. And to be clear, as we've heard earlier, this accumulated debt is not always the result of irresponsible spending and late-night pizza runs. It's also the result of academic fees and textbooks. Research has shown that some students even use their credit cards to pay for their core tuition. Unfortunately, the result of this necessary use is often blemishes in the infancy of their credit history that will haunt them for years. Young adults saddled with credit debt upon graduation can pay up to 25 cents of every dollar they earn servicing their debt, their credit cards, their student loans, and other loans. Entering a job market with stagnant incomes, this generation, my generation, Generation Debt, can ill afford to be financially compromised. This credit card debt, occurred through aggressive campus marketing, impacts our lives, our families, our communities, and our larger economy. So now we know the scope of the problem, but what about the solution? Students, of course, students that we work with on campuses every day will continue their campaigns on the state and campus level to not allow credit card marketing aggressively on campus, to keep colleges and universities from sharing students and alumni lists to credit card marketers, and to improve financial literacy among young adults. But Congress has a simple and significant role to play. We urge Congress to go the extra step and, with young people in mind, mandate a higher level of fairness in credit card terms and conditions by banning several of the most abusive, deceptive credit card practices, those that target students, and encourage greater transparency. Legislative action to protect against abuses by credit card companies is a fundamental issue of fairness and protection of America's future, young Americans, when they are arguably in the most vulnerable and important phase of their financial lives. Thank you for the opportunity.
Thank you very much. And Mr. Neiser, Director of Strategic Programs and Alliances from the National Endowment for Financial Education.
It's great to be here, Chair Maloney and Ranking Member Biggert, members of the committee. I want to extend, with the National Endowment for Financial Education, a personal thanks to Ranking Member Biggert and Representative Hinojosa for leading the bipartisan Financial Literacy Caucus. We're a 501c3 nonprofit foundation based in the Denver area. For 20 years, our organization has funded and created a high school program that has trained 5 million students. Credit card information is a key part of that. 800,000 students were trained last year. And in the college space, we've worked with the NCAA on sports betting, credit card issues, and created the first financial literacy program for the United Negro College Fund, among other organizations. Last year, we launched cashcourse.org, which I'll explain in a few minutes, as a way to bring to campuses customized financial literacy information that they can co-brand. More people drop out of high school, out of college for financial reasons than academic performance, and this is disturbing. Albert Einstein called compound interest the eighth wonder of the world, and we're right at that point where it can work for you or against you. There is a role for credit in society, but the fog of overuse of credit and misuse of it and ignorance of it can cloud young people, young Americans, of the opportunity that this body has created in so many areas of defined contribution plans and IRAs. They have a failure to launch in those areas, and it may delay their participation for their own retirement security for 10, 20, or even 30 years. And we think there needs to be a balanced approach in education as a part of that. I will provide suggestions in 5 areas very quickly for you. First, financial education, then disclosure, defaults, public awareness, and a culture of commitment. In the financial education area, cashcourse.org, since its launch in January, is a non-commercial, free service that we offer on an institutional subscription basis. 126 colleges and universities and community colleges have signed up already. There are 100 on the waiting list evaluating the program for adoption. This provides information about the world of work, managing credit, paying for college, and several other areas important to college life and financial basics. We are providing many enhancements as the program continues, such as seminar materials, marketing, and higher interactivity through Facebook. I'm pleased to say that Brett Thurman on our panel in the center will be teaching at his campus from this program, using it as a supplement, because University of Illinois Chicago is one of the pilot schools. In the area of disclosure, we believe point of purchase is very important. And the Federal Reserve in 2009, as a result of the Bankruptcy Reform Act, is ready to launch its own unique program that we would have advocated as a legislative change if it was not already in place, but we're very excited about it. Finally, Americans of all ages will see on their credit card statement when the moment of truth is, when they pay that bill, if they pay that minimum payment, how long that's going to take, and the cumulative effect of that. We would ask this committee to monitor that progress, because there are 2 alternatives in that, and to keep a sharp eye on how those results go. This is something we felt has been needed for many years. In the area of defaults, this is behavioral finance, behavioral economics. We all know it regarding the area of auto enrollments has made tremendous progress in the area of more 401k use. Americans need a nudge. They need to be pushed and gently tugged in the direction of their own self-interest. We see 2 areas that could be improved, again, for all Americans. First, convenience checks. When people sign up for a credit card, they're not signing up for a check delivery service. We think that should be an opt-in program. People should say, yes, I want convenience checks, that they should not be sent in to them automatically from the banks. And there's an ID theft area there. In the area of opt-outs, there's a way people can stop solicitations now through an 800 number by the Federal Trade Commission on opt-outs. However, there's an exemption, affiliated sharing agreements. Americans should be allowed to opt into those if they want, or opt out to those to have a full ban on solicitations. In the area of public awareness, we've seen a lot of positive direction in the area of credit scores. People are more aware, even from the commercial sector, of what's at stake as they use credit. However, as Representative Hinojosa has called for many times, we need more information in this area. People need to know about that eighth wonder of the world, the time value of money, the good and the bad of it, and how it can be a balanced approach to live their financial dreams. Working with the Ad Council, we would encourage this committee to see that for the first time in the financial literacy space, the financial basics of the compounding of interest should be addressed. Finally, the culture of commitment. What do I mean by that? With cashcourse.org and its co-branded effect on campuses, No longer can a university president, business school dean say, I don't have information that's unbiased, non-commercial, or well-maintained that I can use. That is available through cashcourse.org. And they should tap into the power of parents and other sectors of society to make this a financial literacy priority. Thank you.
Thank all the panelists for their testimony. The chair recognizes herself for 5 minutes. And first, I'd like to ask Mr. Lawsky, what role do you believe legislation should play in addressing these problems? You mentioned one that you're working on with Congress, but are there any other areas that you think are appropriate at this time?
Sure. I do think there are certainly some important areas for the legislature in this. Our investigation is continuing, and we're still every day finding practices that are troubling. And what happened in our student loan investigation is, as we discovered practices that we thought were fraudulent, misleading, deceptive, problematic, we would work to find solutions to them through our codes of conduct we were developing in our agreements with the banks and with the schools. The question then becomes, we can only do so much. Our jurisdiction is limited. We're in New York and New York alone. Often when we do settlements with a bank, for example, it does have extraterritorial impacts. But at the end of the day, as we discover these practices and try to come up with solutions to them, any systemic solution to them really has to ultimately come from this body and the Senate. So I don't have particular areas I would identify because we're still in our investigation finding them, but certainly with respect to the marketing practices we're finding, with respect to the exclusive agreements and some of the provisions in those exclusive agreements, there are very ripe areas for legislative fixes.
Well, could you publicly talk about what progress has been made by your office's credit card marketing code of conduct?
We are making great progress with the code of conduct. It's not, the there isn't there yet, but we are, again, we are.
Do you have any recommendations you can share with us now?
Not yet, unfortunately. I can say we're certainly focused on the exclusive arrangements and how to deal with them. We're focused also, I should say, and it's in my written testimony, on how potentially exclusive arrangements aren't necessarily always a bad thing. If an exclusive arrangement with a school is done right, and a school does the research required to find the credit card company that really is best for students and really will offer something better for students than other companies are offering through that exclusive arrangement, then ultimately the school, if you flip it around and you change the market incentives, the school can become a driver of good practices and really a gatekeeper for good practices on campus. That's what we tried to do with the student loan industry, and it's something we're working on carefully, and it's tricky, but we're working on it with our code of conduct on the credit cards.
Thank you. Mr. Thurman, you mentioned some students are graduating with a large amount of debt, and what portion of college students would you estimate change their career plans after college due to credit card debt?
Well, first, Madam Chair, I would point out that anything I estimate would specifically just be my opinion, and I honestly would not feel comfortable giving you a number, but I can tell you, as a president of the student government, our student government is a 25-member assembly, and these are some of the best and brightest student leaders on our campus that are elected by every other undergraduate student on campus. And of those 25, I would say there's not a one that isn't currently trying to decide whether it be in the area of medical or the area of law or politics, whether to go into, say, social work or working in a clinic as opposed to opening a private practice or becoming a specified heart surgeon so that there's more money involved. And I know specifically at least two of my friends have already decided that law school is probably the way for them to go as opposed to, say, going to work for Greenpeace or something like that following their undergraduate career.
You mentioned many of students were turning to credit cards to pay for their tuition and books and everyday living. And aren't there other options like Pell Grants?
Yes.
Could you elaborate? And then my time has expired.
Yes, ma'am, I could. Very briefly, at our school alone, about 1/3 of our undergraduate students are Pell eligible, so it's a very focused upon subject. But the Pell is a very intricate system. You may receive a scholarship of $500 that, if put into the system incorrectly, would make you Pell ineligible. So receiving a $500 scholarship would cost you $2,000 in grants. And obviously, this is something for a different committee to hear. But also, more and more students are going to summer school now because it's very difficult to attain an undergraduate degree in 4 years. There's very little financing options available for summer school. As a matter of fact, if you want federally subsidized loans for summer school, it has to come from unused loan amounts from the previous semester. So credit cards is where that can come into play to help a student accomplish that goal.
Now the chair recognizes Mrs. Biggert for 5 minutes.
Thank you, Madam Chairman. It was noted in the testimony that Mr. Inhofe and I have worked a lot on financial literacy and started out working with the federal government and the agencies and really wanted to bring this to work with the private sector too, to have some accommodation there. And Mr. Neiser brought up the cash course, which I have to go online to see what's happening there, because that's very exciting that you're using that in so many schools. I just wondered some of the others, like Ms. Lindstrom, what are you doing anything on the campus for financial literacy? I know you said in your testimony that financial literacy should be enhanced, but is there a way that your group, PIRG, can help to do that? Since you are on, I don't know how many campuses, but.
Sure. Yeah, did that work? Oh, here we go. Yeah, like I mentioned, this booklet helps students. It's a consumer guide to credit cards, and we're passing out thousands of those on campus. I think what's particularly exciting about our education effort is that it sort of penetrates all the other advertising that young people see and educates them because it's a tongue-in-cheek effort where we're looking like a credit card marketing effort, but we're not.
But is
so
there anything?
That's the main approach that we're taking to educate students through our effort.
But there's nothing as far as getting into coursework with the universities or anything?
Certainly it comes up in our one-on-one conversations with administrators when we're discussing, principles for responsible credit card marketing and some of the things that the campus can do to clean up the marketplace. But, I think our bottom line is increased financial literacy alone just isn't gonna do it. The marketplace is unfair right now on campus, and the products are poisonous. So
if I might then, I'd like to go to Mr. Clayton. Can you describe some of the efforts that the issuers have made to educate students and young people about responsible credit card use?
Yeah, thank you, Mrs. Biggert, for asking. I think it's very important, and it's along the line of what Mr. Scott was talking about, too. This focus on marketing is kind of looking at it from the wrong end. You kind of have to flip it around and say, look, we have to empower people to make choices that work for them, not make the decisions for them, but help empower them to make those choices. There's a whole range of activities that credit card companies, consumer groups, and others have been engaged in, and Mr. Neiser has been talking about this too, of getting out there and trying to educate people. But I would,
how do you get out there? Is there any initiatives with the college administrators or student governments to encourage greater financial literacy?
Absolutely. I think there are a number of examples of institutions working specifically with universities. Remember, as was noted before, students in institutions and colleges and universities work together to figure out what the right way to present these things are. And institutions will only act within the bounds of what the college has basically set out as their criteria for marketing stuff. So I know a number of institutions actually teach courses on campus. There's always handouts, and similar to what we're talking about here, when people get applications for credit cards that basically, trying to educate people on what's going on. There's a host of resources online. And the bottom line is we have to do more, but I also want to stress we have to do more even before college. I mean, there has to be a concerted effort on the part of the states, institutions, and others to kind of.
I love the NFL and Visa, the football, financial football. Everybody has done that online. Mr. Thurman, what do you see that you can do in the student government to encourage it. And do you think the courses should be offered just on financial literacy or mandated, or is this something that maybe, did you have a course in high school or anything, economics?
No, I didn't, Mrs. Biggert. Boy, you asked if I think it should be mandated. I think you're going to get me in trouble with my dean. I think
I don't believe in mandates, by the way. But.
I think the key problem that comes up in educating students in financial literacy is who's going to do it and who's going to be responsible for it. It does nothing for a professor's promotion and tenure track to add a course of financial literacy to their course burden because it doesn't affect their academic scope. If you're the dean of a college, how are you going to find the placement for it in terms of space, the time for it in your programming, and also the pay for whoever is going to teach it? And these are things that possibly could be looked at a federal or more public level, some type of incentivized, or, as was mentioned before, talking about it in high school, talking about it before someone signs up for those first set of loans before they go into their freshman year, their first credit card before they go into their freshman year.
Well, I think that we've had the consumer ed in high schools, but it doesn't seem to have really covered this, maybe because I remember it a long time ago before we had all those credit cards, but thank you. You're back.
Mr. Watt for 5 minutes.
Thank you, Madam Chair, and let me thank the Chair for convening the hearing on a topic that I think is very, very important for us to be dealing with. There are obviously advantages to students for having credit cards, but there are also some concerns that need to be addressed, and I want to zero in on 3 of those and get Mr. Clayton's reaction. The 2 concerns that I'm most focused on is the aggressive marketing and the issuance of convenience checks it frustrates me if I get a convenience check from my, it seems to me that I didn't request it. Seems to be a waste of money for people to send them to me. I typically throw them in the trash can immediately, or actually you need to shred them. I worry about throwing them in the trash can because they have an account number on them already. So I just want to know, and maybe you've already addressed this question on the aggressive marketing side. You kind of turned the equation and said we shouldn't focus on that. We should focus on literacy. I'm a strong supporter of financial literacy, but there has to be some limitation on the aggressiveness of marketing on campuses and elsewhere, but particularly on to young people. You agree, disagree?
I think, well, a couple things. Let's put this in some factual context.
I don't want you to put it in context. I want you to tell me whether there are any points beyond which credit card companies shouldn't go in aggressively marketing to young people. I mean, then you can put it in context if you want. But I mean, I'm not trying to cut you off, but I don't have but 5 minutes here.
Now, these are adults, and we understand that, and we understand that we're in a marketing society, and there are always going to be aggressive activities on the part to get noticed. The ultimate determiner.
But you think it's appropriate to this example where to be giving a Subway coupon and then getting there and you're not getting the sandwich, you're getting a credit card? You think that's an appropriate practice?
I think it's safe to say that Mr. Thurman didn't get a credit card with that company. I mean, and so I think
that's not the question I asked, though, Mr. Clayton. I appreciate you trying to avoid the question. I'm trying to find out whether you think there are some outer limits to the aggressiveness of credit card marketing to young people.
There are outer limits that the states and the federal government.
And where you think those outer limits
Well, that's
are?
an arbitrary standard. I mean, it's unfair and deceptive acts and practices standards that are in the laws and in the books, and people get to enforce that. So, I mean, I can't tell you what line, what chapter and verse this is okay and this isn't, because that's a kind of.
What about convenience checks? What's your opinion on that?
I'm not really prepared to respond at this point because we're not really talking. That wasn't necessarily in the context of the student credit card market, but
Well,
I mean,
I didn't put it in the discussion. Somebody, Mr. Neiser, put it in the discussion. He said you were credit card companies are routinely issuing convenience checks. Yeah. Kids don't. They get a credit card. Yeah. Okay. This, you know, it's offensive to me to get a convenience check with my credit card. I use a credit card to charge things, not to borrow more money, which is what I can do with a convenience check. I can borrow money on my credit card. You think that's appropriate?
well, for some people it is convenient, and some people use it for valid purposes, and that's their judgment to make. As a practical matter, I think you talked about what you did with it was appropriate. If you don't agree with it, you throw it out, you shred it. I mean, these are not hard and difficult standards for people that don't want.
What happens if I throw it in the trash can, somebody else picks it up and uses it? Does the industry protect against that? I didn't want it.
I mean, typically the industry does protect against people that are subject to fraud. I mean, as you can see, as you've seen in the credit card market generally.
All right, my time has expired. Let me just ask Mr. Thurman one thing quickly, Madam Chair. Are students aggressively taking action against college administrators who are issuing student lists? I mean, that seems to me, I guess if I were a credit card company, I would want the list of all the students. That's a college failing. What are we doing about that, if anything?
Well, Mr. Watt, I would point out, first of all, that our university, the University of Illinois at Chicago, actually does not participate in that kind of practice. So our students don't have a reason to take aggressive action against the administrator. But perhaps Ms. Lindstrom might be able to give you some information about what's happening on other campuses.
Sure. Yeah. What we found is that there we go. What we found is that in quite a few states, the public university system feels a compulsion under disclosure of public records law to have to give up all of the current information of students on campus to almost anybody who asks for it for free or for a nominal fee. And so ultimately that's just getting into a different area, but the practice actually is occurring in a set of states and doesn't occur in other states because of public records law. So one of the suggestions that we made earlier is that students be allowed to opt in or opt out, know that that's going to happen with their name so that they have some control again over how they might be marketed to. But it is an interesting state law issue in quite a few places.
Thank you, Madam Chair. Yield back.
Expired. Mr. Castle?
Thank you, Madam Chairwoman. Mr. Clayton, on page 5 of your testimony, there's several rather interesting statistics, which are 41% of college students have a credit card, which surprised me. I thought it would be higher. The students with credit cards, about 65% pay their bills in full every month, which is higher than the general adult population. Among the 35% who do not pay their balances in full every month, the average balance is $452, which is down 19% from 2007. And 74% of monthly college spending is with cash and debit cards, only 7% is with credit cards. Mr. Neiser, in your written testimony on the first or second page of it, it indicates that the undergraduate today leaves campus with $19,000 in student loans. Student loans are a whole different issue. I happen to be on that committee as well, which is a whole problem, I might add. On top of that, half of all graduates in 2004 used credit cards for school expenses, carrying an average balance of $3,900. It seems to me to be an inconsistency in those two sets of numbers. Maybe there's not. Maybe one or both of you could explain how you came up with those numbers or what the consistencies or inconsistencies are.
Well, I'd be glad to jump in first and then turn it over. I mean, as a practical matter, this is a study from Student Monitor from 2008 that surveys students and what their experience has been, and so that's where that number comes from. I would note, though, it is relatively consistent. I was actually surprised at the 41% number, too, because I think it's actually probably higher. But there have been other surveys that the GAO has done back in 2001 that Professors Barron and Staten have done in 2004 that yield consistent numbers in terms of the extent of debt that's out there, the amount of people that are essentially paying back in full on every month. And so I do think that, you know, as we feel comfortable with saying to you that debts are within reasonable limits. And frankly, it's also a product of the marketing. Credit card companies don't give students open checks here. I mean, they don't just sit there and say, take a $10,000 balance. They start them off slow. They work them through it and see if they're capable of
Well, just to follow up, I mean, Mr. Neiser's testimony indicates the average balance is $3,900 when they graduate. And the suggestion here is that the average balance is $452 for those students who don't pay their balances in full every month, which I imagine is the ones with a higher debt, if I had to guess. Those are dramatically different numbers.
It was, I don't know if the number that Mr. Neiser was talking about was the average balance of a graduating student or not, but there's a range of things. I'll defer.
In our testimony, it's half of all graduates carried that debt, and it was the average balance of those half was $3,900, according to the American Council on Education, June 2005. So it's not all students. It is the half that carry that have that average balance.
Well, I understand that, but you're talking about a 35% here and a half there, and you're talking about vast differences. I think somehow or another we as a committee need to get those figures straightened out, because I think they don't seem to be quite consistent with one another. Mr. Lawsky, let me ask you a question. You indicated that when you testified, the subpoena of agreements between the credit card companies and the schools, when revealed, will shock us. And then you went on to say that the colleges allow the credit card companies to get addresses, other information, access, et cetera. Is that the shocking information, or is there something you can't testify to now because of your legal position that will be shocking that we don't know about yet?
The latter.
So there are things that will be revealed, hopefully, at some point later. Is that correct?
Yes, sir.
To perhaps, Mr. Lawsky, to you, and perhaps to Mr. Clayton, or anyone else who wants to answer it, with respect to what the colleges are doing, and with respect to the information about the different students and that which is given out to the credit card companies, what is the relationship between the credit card companies and the colleges, and is that being taken up? It almost sounds to me as if in certain instances the colleges have a responsibility here in terms of their administration, as opposed to just the credit card companies and the students in terms of what information is allowed to go out. What is being done by the credit card companies with respect to control that information, and what, if anything, are the college and university administrations doing to make sure that that may be brought under control if that is a problem, if you know?
You're asking about the flow of information from the universities about students to the companies?
I'm talking about the flow of information from the colleges or universities to the credit card companies, which I believe you testified was a problem. Is that issue being addressed either by the credit card companies or by the colleges themselves?
I'm not sure. I don't think I know the answer to that. Maybe Mr. Clayton does. I can tell you that there is, in the relationship between the universities and the credit card companies, there is clearly a money flow from the credit card companies to the universities in exchange, at least in part, for student data, email addresses, home addresses, school addresses, telephone numbers, to allow the marketing. The information I've seen indicates that that is just a financial give and take. I didn't see protections built in there. Maybe they're there and I'm not aware of them, but to my knowledge, it's simply an economic transaction.
Well, I understand what you've testified. My question is that a problem? Is anyone doing anything about it if it is a problem?
Well, I think that Mr. Lawsky referenced it earlier. The colleges can act as a gatekeeper, and they get to control this relationship, and they have to determine what's right in the best interest of their students. I'm not privy to the specific agreements in terms of what is shared both sides, but you really want to turn to the universities that are the ones that are getting into endorsing these products, and if they don't think something is appropriate, just like I understand they did at the University of Illinois, they say no. And that's the gatekeeper.
Thank you.
The gentleman,
Thank you, Madam Chairman.
in response to one of your questions on the statistics, the Nellie Mae survey for 2007 will come out in July, and the Fed survey for 2008 will come out in August. The chair recognized Mr. Clayton for 5 minutes.
Thank you.
Lacey Clay for 5 minutes.
Thank you so much, Madam Chair. Mr. Clayton, in the beginning of your testimony, you state that not all students will manage debt in a responsible way, just as not all adults in general will manage debt without experiencing problems. Aside from being a vague statement, you fail to recognize that most adults are receiving an income each month, whereas many college students who, yes, are legally considered adults are unemployed or have low-paying part-time jobs. As you are supporting the marketing of credit cards to college students, how do you suggest we address the issue that the majority of students do not have the money to pay off their debt on time and therefore are finding themselves in immense amounts of debt upon graduation? Oftentimes, the offering of credit cards to students is a lure to indebtedness, as they view credit cards as money and use them as such. When you know that this is the end result, and it seems to be pretty predatory in nature when the offer is made to these individuals.
Well, let me make sure. There seems to be some discrepancy in the numbers, and we recognize that. And it just to us, it says that there more needs to be done to figure out what is really going on out there.
Mm-hmm.
I mean, we take the perspective from the numbers that we've seen that this predatory lending that you're talking about doesn't really exist, and then in fact a good portion of students are acting in a responsible way and handling that credit, and it's opening doors to them. Remember, the thing we haven't really talked about is how this helps them build a credit record that allows them to get a car loan or a home loan and be productive members of society as they get out of college. But we're not seeing the same message, and we're seeing, you know, again, we operate in the college space with much more confined underwriting. We limit the amount of credit that a student can take down as a practical matter, and the results from our perspective speak for themselves. I would note also, there's been a lot of discussion about this massive marketing. There's a lot of information flow in this society. There's no way to really necessarily contain that information flow. It's going to come from various places. But one of the things that our people are talking to us about is how little or few students actually sign up for these on-campus marketing techniques. Now, they obviously view it as productive to do, to get their names out there, and oftentimes, frankly, they market it at sporting events because they're really shooting at the alumni and their friends of alumni, not necessarily the students. But, I mean, just one aside, the Student Monitor study came back and said only 2% of credit card that students actually obtain is through these on-campus marketing activities. They happen elsewhere. So I guess what I'm trying to say is we're not really starting with the same premise that these aren't necessarily predatory, that they are opportunities. And I think others have recognized this is a real value to people that need money. To the extent that there are broader societal issues brought to bear here, such as the impact of student loans, that's clearly a case. I would say that, just as an aside, when we looked at the Student Monitor study and what they talked about the amount of student credit card debt versus the amount of student loans, student credit card debt represents less than 1/4% of overall student loans in terms of the debt that's.
Okay. All right. Thank you for the response. Ms. Williams, in your testimony, you mentioned several times how young adults are more frequently using their credit cards to pay for basic school expenses such as tuition and books, citing research done by USPIRG. If credit cards are issued to students who are inclined to pay for school expenses in this manner, then do you agree that by using the credit card, students are paying almost exponentially more interest than by using student loans? Do you agree?
The question is, do I agree that by using the credit cards to purchase?
Students are paying exponentially more in interest rates.
Absolutely. I mean,
Okay.
the interest rates for students are considerably higher because of their thin credit history. So if you look at that comparatively to student loans, yes, I do agree with that statement.
Is the ease of obtaining credit card financing creating greater debt for these prospective professionals?
It is, and I think that's getting to the heart of what some of the other witnesses, Mr. Thurman and Ms. Lindstrom, are suggesting. It's not a matter of denying access to the cards. I wouldn't even necessarily say it's the ease with which they have access, but again, it's the predatory nature of this kind of aggressive marketing on campus. And we're talking about, we're talking about young adults. They are indeed adults, but this is in a way the childhood of their financial lives.
Sure. And shouldn't we be about creating less debt and less hurdles for young people who are coming out of college?
Absolutely. I mean, the impacts, again, are not just on the students themselves, but on their lives, on their families. We mentioned the boomerang effect of young Americans having to move back home. We mentioned, Mr. Thurman mentioned some of the impacts in the economy and job choice. I think it's an overall broader societal issue than just is simply incubated on that campus.
Well, thank you so much for your response. I yield back.
Thank you, and the chair recognizes Ruben Hinojosa, chair of the Higher Education Subcommittee, which also is reviewing this challenge, and co-chair of the Financial Literacy Caucus. So for 5 minutes, Ruben Hinojosa.
Thank you very much, Madam Chairman. I want to thank Chairwoman Maloney, and I want to thank Ranking Member Judy Biggert. I thank them for holding this extremely important hearing today on a subject that is very near and dear to my heart, and that is ensuring that higher education is available and affordable to as many students as possible. Chairwoman Maloney, I am proud to be a co-sponsor of your legislation, H.R. 5422, entitled the Credit Holders Bill of Rights Act. And I was more than willing to co-sign the letter to federal regulators in support of the proposed rule to ban unfair or deceptive credit card practices. As chairman of the Subcommittee on Higher Ed, I am very concerned that more than 100,000 students each year do not enroll in higher education institutions because of financial barriers. I'm equally concerned about the amount of debt that students are incurring while attending institutions of higher education. And I've been working diligently to make college more affordable and ensure that students graduate with the least amount of debt possible, including credit card debt. At this point, Madam Chair, I wish to ask for unanimous consent to submit for the record 3 documents that I have with me. The first one is my complete statement, which is much longer than this condensed statement that I've just made. Secondly, I'd like to ask unanimous consent that a report by USPIRG entitled The Campus Credit Card Trap, and that acronym is it stands for a survey of college students and credit card marketing by the U.S. Public Interest Research Group Education Fund, and this report is dated March 2008. And lastly, I'd like to ask unanimous consent that the report that was released, a press release from House Education and Labor Chairman George Miller on the FTC's new consumer guide on student lenders' deceptive marketing practices, and a copy of that guide entitled FTC Facts for Consumers, Student Loans, and Avoiding Deceptive Offers.
Without objection.
Thank you. Chairman Maloney, I again applaud you for your legislation and letter and your dedication to this cause. And I wish to take this opportunity, since I still have part of my 5 minutes, to ask some questions. I apologize that I'm a little bit late and didn't get to hear the witnesses make their presentations, because I was at an event where I introduced some very important people, including Senator Clinton, and that made me a bit late. I know that this young man, as one of the witnesses, was testifying about his experiences on the college campus in Illinois, and I was delighted because that opened then the door for me to talk about the need for the financial literacy education programs that are available and mandated in some states, like my own state of Texas. And that, of course, would help them be prepared to go to college and better handle debt as they start their college education. Can you tell me if there are any other states that are requiring this? Maybe students who came to your campus that had already taken those courses back in their sending state?
Sir, on the level of states requiring that, I don't have that information. Perhaps one of the other panelists might. My area of expertise is very much limited to the University of Illinois at Chicago. And I do know that we've started developing a program for our students, but in terms of state requirements, I don't have that information.
Well, with the strength of the student body that you represent, possibly you all could start a move throughout the nation that there's 14 states, according to a note that was just given to me by staff, that already mandated through their legislature. Ours is the Texas state legislature. And possibly that might help Judy Biggert, my friend from Illinois, who is the co-chair of a caucus that is working with about 87 other members to try to get this program out into the country, and particularly to students who are looking for accessibility and affordability to higher education. But I think that I will then go on to ask another gentleman who is, there it is, who is on this panel, and I will ask one question, Madam Chair, of Kenneth Clayton, Managing Director of the ABA Card Policy Council. I've had several representatives from organizations like yours coming to visit my office and talk to not only me but my staff, trying to tell me that they have mended their ways and that they've fixed things up to where they are no longer charging for things that I was upset about, and that is that if they are late in making their payment, that you can easily take the rate at which they started out using their card and bump it up to as high as 28% plus late payment fees and other fees that just make it almost impossible for them to ever get out of debt. What is your organization and your members doing to discontinue that?
I think if you've seen, there are choices in the marketplace where various participants have either decided not to make these these type of rules applicable to their products or not. I mean, so consumers can say, I don't want this, and I'm going to go get this card, or not. There are a number of institutions that market very simple termed cards, and I can't get into a marketing campaign for them here, but the bottom line is they have various products out there for people that want to have these things limited. I think the other thing I want to stress here is, as you know, the Federal Reserve has moved in this space in a dramatic way. I think most people have recognized that it's a very broad proposal that they put out to address some of the concerns that have been raised in this committee, to the credit of Mrs. Maloney and others, and they're looked very seriously at. We have some concerns with those proposals because we think they have the net effect of driving up costs to a wide variety of people and end up unfairly having people that pose higher risk actually be subsidized by those that don't pose risk at all. But that being said, there's going to be a lot of addressing of these issues that people are talking about. The Fed will act, and it will apply a standard that everyone's going to have to apply to.
With all due respect to you, as with your title of Managing Director, I will say that I received 2 to 3 applications for credit cards, and to this date, in the last 10 years, I've not received one from those companies that have simple, easy credit terms like you just described. All of them have little fine print at the bottom that if I'm late, that if I'm this and the other, I will get penalized. I will have late payment fees. So evidently, Congress is going to have to step in and just make it universal so that all of the companies will have to change.
I thank the gentleman for his comments, and your time has expired.
Thank you,
but
Madam
made
Chair.
many important points. Congressman Scott for 5 minutes.
Thank you very much, Mr. Chairman. It's been a very good hearing. Let's talk specifically about what we can do as a Congress, what kind of legislation we can put forward. What we got here is we've got a captive audience of young students on a campus. They're at a very vulnerable part of their lives, and the testimony is very effective. Let's start with number one question. Number one, would you favor legislation that would ban this activity? There's documented evidence that there is agreements between many of these universities and credit card companies, of which these universities are paid huge sums of money for the right to market their credit cards to their students. Would you favor legislation to ban that? Anyway, hurry up, my time is ticking, and I have quite a few more. I mean, I'm trying to get at some issues here. I mean, if you want us to do something, this is something we can do. I mean, is
Sure.
this something we should do?
Yeah, I think I'm excited to see what the Attorney General in New York, what their investigation turns up in terms of the relationships, and I do think that there should be accountability once we know what actual relationship exists. I think right now, some of the things that we're particularly interested in terms of legislation to clean up the campus marketplace are the same underwriting standards for students as the rest of consumers in society. So as we mentioned earlier, there are lax standards, and as a result, students don't need to meet the same criteria, and they get...
Well, so let me just ask this, because she's going to put the hammer down on me. I just want to know, is it okay, I mean, is it fine that these card companies can come pay these universities money to have the right to come in and market their product to their kids? Because this is an industry, they're already doing it at a tune of $1 billion a year. I mean, we heard a lot of complaints here. Once they get the right to get on campus to do it, this is capitalism. They paid the right to have access to those kids.
Right.
Do we stop that at the gate? Do we stop the folks at the gate and don't let them get on the campus? That's what I'm asking.
Mr. Scott, if I may. I would suggest the answer to that is yes. And I would suggest that based on a couple simple premises. First, in some university environments, especially in rural campus environments, what you have is an extraordinarily captive audience. And if the university is going to sign some type of exclusivity agreement, and I do believe that's what we're talking about, that's only going to allow a particular company access to those students, we're not just talking about those students just drinking Coke instead of Pepsi. We're talking about those students having access to only one set of terms of interest rates, of payback terms, of late fees, of overdraft fees. And for that simple reason, for starters, before we get into anything else, I would suggest that that's a reason alone to ban exclusivity agreements on campus.
Ms. Scott, I guess we'd have to oppose it. I mean, we really do think that in many instances, schools, and I think Mr. Lawsky actually talked about it, schools actually can get benefit from this, that benefit the students that they're actually serving. I would also note that whether you're in city areas or rural areas, we are in a very open-ended communication of society. You can get access to information on the internet wherever you're sitting. So you can get it from your local bank. You can get it from other places. Regardless of what arrangements a college makes with an institution, it's not the exclusive way to gain access to students.
But I think the point we want to make is you listen to the young people and what they're saying. And there's some victimization that is truly going on here with the credit card companies, combined with the lack of the literacy and education. They're just sitting there. And the other thing is, okay, once we get them on campus, and so we got a tie here, we got a draw here, 50-50, some say they should. But if they get on campus, and then the next thing you come with, they're giving these gifts. And the data says that 3/4 of all the students that come and get the gift fill out the application. There's a real little strategy here. You feel a real responsibility. You're going to take the teddy bear. Okay, you take my teddy bear. You got to fill out the application. You fill out the application, it's gone. So, should we pass legislation to ban giving of gifts?
Sure.
Let me just jump in for a second. First of all, when we talk to institutions, they basically tell us that the primary vehicle for them signing up people with card agreements is through when those people come into the bank branches and open up savings and checking accounts. That it's not, we think it's overstated that these gifts are necessarily driving all of a sudden consumers to take on a great deal of debt. I mean, I don't think that gives enough credit, no pun intended, to the students.
Mr. Clayton, the PRIG survey I'm reading from here reported that 3 out of every 4 students reported stopping at tables to consider or apply for credit cards when they were offered gifts. Now, there's a direct correlation here, and we're trying to get at things. If we do let you on the campuses, then the issue becomes you're giving these gifts. The kids there feel an obligation to fill out the form. Once they do that, they're hooked into it. So it is a system that is going on here. Universities need to wake up. I think they have a responsibility here. If they are signing these exclusive agreements, they're giving carte blanche to turn their kids loose to people when they come in, and this is a business. This is the old American way. They're going to be aggressive with their tactics. Once they pay the university turns them loose to the kids. Then they come, they give the kids gifts. Then they're paying the kids. I mean, this is a little system here, and I'm just simply saying we need to look and take a look at some of the deceptive practices. My final point is that I wanted to get at that is, because my time is up here, would you support legislation for parental? Would you support federal legislation that requires that before the kid can get the credit card, that he has to have a cosign with his parent or guardian?
Answer quickly, because the gentleman's time has expired.
We would support students being subject to the same underwriting standards. So that means that if the student has no income or other assets, then I think maybe considering the formation or encouraging a starter card for students who have no income or allowing them to get a card with a cosigner makes sense. But I do think that students should be treated like everybody else. And a vast majority of students do have an income and do have a job and should be able to get credit and have a credit check just like everybody else relative to the credit that they qualify for.
Okay. Thank you. The gentleman's time has expired. And Congressman Cleaver.
Thank you, Madam Chair. I want to follow up with Mr. Scott's questions. Mr. Clayton, do you disagree that some of the practices that we are discussing here today are very similar to the practices that led to the current subprime crisis with the 1.3 foreclosures as of today, a predicted 6.5 in the next 5 years? Do you believe that there are any parallels?
I do not.
Okay. So is there a parallel between giving people credit for homes that they can't pay for and giving people credit cards that they can't pay for? Do they sound similar?
No, I don't agree with that either, because what we're seeing statistically is that they can pay for it.
Yeah, that's what the people said when they gave the people the subprime loans. Almost the exact words. That's the same logic they used. And we're having 20,000 foreclosures a week. So you think such legislation is fake?
I'm sorry?
Fake, F-A-K.
And is fake in what respect? I mean,
no, on page 7, you said that this is artificial, and a synonym for artificial is fake, bogus.
We think that artificial constraints will have the effect of limiting the ability of very responsible adults to get access to credit that they use for very valid reasons.
Okay, so you believe that if we required that students who don't have a job receive a credit card, as Ms. Lindstrom has said, in the same way that other individuals are marketed. In other words, if they don't have credit, they don't get a credit card. And if they want a credit card, someone must sign for them, just like a car. If you don't have a job and you want a car, your parents have to co-sign for you.
Not everybody has the parent that is either willing or able to sign for it, and so you end up taking those people out of the marketplace.
Well,
judgment that you make, and I understand that, and that's certainly the prerogative of the Congress.
Yeah, the legislation says a parent or an adult, anyone who is willing to co-sign.
But there may be adults that don't have that.
That is absolutely true, and that's why we have the subprime crisis, because people were getting things and they had no backup, they had insufficient income. And we're leading the figure that's been used about the number, the debt comes from the Nellie Mae Corporation study. And if people are leaving college with almost $3,000 worth of debt and no job, doesn't that sound like we have a problem?
The numbers are nowhere near what you're talking about in the subprime crisis, as you know. And the Nellie...
I beg your pardon?
The actual dollar numbers that you're talking about in the credit card space is much less than what you're talking about in the.
So it's not, we shouldn't be concerned if people don't lose homes. They just start out in their adult life broke.
We're not saying you shouldn't be concerned. We should be concerned. We're saying that some of the remedies will create greater problems than the problems that actually exist that are being.
Tell me the problem created by requiring a cosigner.
All I can do is respond from the perspective of someone who may not have a cosigner to make that. They will not have the benefit of cards to take care of a car that breaks down or to buy books. It's not that we're saying that the credit card should be your first choice to use as to purchase books. That's a deeper issue of whether the funds are available to make those purchases.
Your job is just to give them the credit card.
We find that our job is to allow consumers to benefit and actually get.
So you're doing a favor. You're providing a service.
Lots of people would tell you that we are.
Mm-hmm. Now, you talked about the Federal Reserve, and they are, in fact, working on regulations. But we both, and you and I will agree that that's not a law.
That's correct. But it's a basis of a law that Congress passed previously.
You would prefer to have the Fed draft regulations than have us put a law in place?
Laws can end up imposing very restrictive solutions on things that.
That's the point of laws. We put a stop sign. We want to restrict you from driving through. That's what laws do.
I understand, and it's your prerogative.
And we're trying to keep people from running people into debt. Young people getting a start. This nation is minus 0.6 in savings. Minus 0.6. Asian nations are almost 20% savings. They're trying to stop people from saving so much of their income in Japan. The 0.6 means we're going the other way. We ought to be trying to work with laws and whatever else we can do to prevent this from becoming another crisis. Sir? I disagree. Let me ask you, Mr. Lindstrom, do you think most of the students on campus understand universal default?
No, I don't think they understand.
The gentleman's time has expired, and I thank him for his questioning. And the chair recognizes Walter Jones from the great state of North Carolina.
Thank you, Madam Chairman, and we're so proud of you because you were born in North Carolina, and so we thank you for remembering your roots and by welcoming me. I want to thank you. I don't know if anyone, I had to be out for a few minutes. Has anybody mentioned the parents who have to pay some of these charges in your testimony?
I tried.
Oh, you did? Okay.
I tried.
Okay. All right. Well, I apologize because I missed your. That's the reason I asked that. And I didn't know my colleague has been one of those parents. But this is one of the issues that I have had. I'm not going to exaggerate, but I will say in 14 years, I've had many concerns and complaints from parents. And you have touched in your testimony, and I thank each and every one of you for your testimony. You have touched on the fact that too many times these universities are being paid to send a person's name so they can send a card to that individual. I think that's going to be addressed, I hope, in this legislation, or will be addressed. I think it's wrong. Not only do I think it's wrong for the student, but I think it's terribly wrong for the parent if that student is 18, 19, or 20 years of age, or maybe even older. Maybe, Ms. Lindstrom, you might be the one to answer this question. I had the staff very kindly help me with profits by the credit cards. I want to read this, and then I'll zero in on my question. The credit card industry is the most profitable one in the United States, with annual earnings in the $30 billion range. Many people might be surprised to learn that a single credit card issuer, MBNA, earned 1.5 times more profit than McDonald's in 2004. Citibank, another major credit card issuer, earns more profit than both Microsoft and Walmart. How much of the $30 billion, what percentage would you say is targeted and percentage comes from students who use their credit card?
Yeah, I actually don't know the answer to that question. I'll have to get back to you on that. I don't know the breakdown of the profit
How about
margin
Mr.
and what
Clayton?
sector it comes from.
I don't have that information. I would also note that a lot of card companies actually have students that get their cards that are not marketed as students. They're just part of general marketing efforts, so they may not be able to identify if they're students. But I suspect it's still a relatively small number as a percentage of the overall profit.
Would anyone want to guess, is it 1% or 2%? I just, to see this, and I realize that when you are zeroing in on these young people, the hope is that they will be a user of that card for years to come. I realize it doesn't just stop when they graduate from college. But I wonder if there's anyone that, to me, you're putting tremendous amount of money into a marketing effort and you're zeroing in, and I realize that's not just for the short term, it's for the long term. Would anybody be able to respond to the point I'm trying to make, or the amount of money that you are going to, if the $30 billion, you can't tell me that 1% of that $30 billion, and I understand if you can't, is coming from the college effort?
Well, yeah, I mean, I would respond with the fact that what we're talking about here is a captive market and a highly desirable market that the industry is clearly going after in a very concerted way. They want to become the very first card ever in somebody's wallet because, you know, I guess marketing studies have shown that folks develop some kind of sympathy or just get used to that particular card. And so you're more likely to get a customer for life if you can be the very first card that gets into somebody's wallet. So I do think what you're talking about is correct. The investment in getting at students is all about the sort of the long-term payoff, regardless of whether or not, you know, there's a 1% of the overall profit margin comes from the particular student consumer right now. I think the push to get into the wallet is what creates the dirty marketplace, as it were, that exists on the college campuses for students.
And the student is charged the same percentages, late fees, just like a person 30 years old or 40 years old. I mean, there's no break for the student.
No, I mean, again, we only have anecdotal information, but we do know from our student constituency that students do encounter worse terms and conditions than it seems like their parents would, for instance. So a 0% teaser rate that you get, an interest rate for 6 months, that then jumps up to 29%. Or you were late on a payment and then you, or something along those lines. We've actually gotten reports, students reporting in that they're paying an interest rate of 38 or 39%. So again, this is all anecdotal. We don't have any real information to back up that, but we have a sense that the terms and conditions are particularly filled with the gotcha fees in a way that is not necessarily the same case for the broader consumer marketplace.
Thank you. Thank you, Madam Chairman.
Thank you. In the spirit of bipartisanship, there'll be 2 additional questions, one from Mr. Scott and one by Mrs. Biggert, and I'm told we'll be called for a vote shortly. So, Mr. Scott.
Yeah, thank you very much. Just very quickly, and I appreciate the generosity of our chairman, because I think that you made a statement there that we treat these as the same as we would adults, but that's not fair. The adult has a job, they have a house, they've started in life, they're there. These are young people just starting out. There ought to be more of a nurturing and a caring as you're starting them out on this journey. I firmly believe we've got to do something with turning over these exclusive rights to these universities who are getting billions of dollars to make available these students. We've got to do something about the enticements being used to attract the vulnerable students to it. This is a business that is not just with the product. They make the money. Credit cards make their money on late fees, penalty fees, interest rates, compounding interest rates. My question, just to give an example, is that even right now, why could we not, would it be possible, would you support us making sure that even if, as we move forward, that we ensure that the full amount of a payment is listed as in the payment box, as opposed to, say, the small minimum payment that is there? If we do that, I think it would help encourage the student to pay off more of his debt or pay in full each month if we show the full amount that is there. My point is, by only making minimum payments, let's say on a $1,000 balance, that can lead to a debt that would take just that small amount 7 to 15 years to pay off of. I mean, these are just small things that I think we need to do. And I fall down on the side of we need to do and go the extra mile for these students. They are not the same as adults out here. And we need to do something about the universal. But my point is that possible for us to do? Just that one simple thing so that we could cut down on the amount by putting the full payment in there. Yes, sir.
Mr. Scott, any time that Americans can be faced with the brutal facts of what they're spending and the potential consequences of not paying things off is an educational and a teachable moment. And the same thing has to happen on the savings and investment side. It's disclosure. It's what behavioral economists say is it's the moment of truth. And we can't have information in the shadows to cause people to find 10 years later that they made a mistake. And again, as my testimony indicates, the Federal Reserve regulations coming forth in 2009 to disclose more of what that hard, brutal truth is to Americans is encouraging, but it needs monitoring.
Okay. So you agree with that?
Yeah.
Good.
In general concept.
Thank you. Now, the one other point that I wanted to ask was that what if we had a way in which the, am I okay?
Sure.
All right, thank you.
This is the last question.
Last question. See, because we need to help the students here. If we require a monitoring, if you don't want to go with my plan for the co-signer of the parent, because you got to have the parents in here. They don't know. Kids are up there. It's free money. I mean, we're in a credit-conscious world here. But what if we put a requirement in that on a certain periodic basis that there must be a monitoring by the parent or the guardian, that the bill is not just sent to the student, but that there is a requirement that monthly bill goes to the parent as well. Because if the youngster does not fulfill his obligation, somebody's got to do it, and it's normally they're going to go to the parent anyway. The quicker we can bring the parent or the guardian into this situation to help in that might be helpful.
Sir, I would suggest that, in my opinion, I would be opposed to that for a couple of reasons. The first would be what I would think, just from a student perspective, some obvious privacy concerns, because although it is a young adult, it is an adult past the age of 18, as Mr. Clayton has pointed out. But secondly, as Ms. Lindstrom has asked, if we do, in terms of our conditions for allowing them to have credit cards, if we do apply the same conditions to students as we do to, say, a 27-year-old line worker at the Ford Motor Plant, then what we will have is we'll have a student who has a part-time job allowed to have a credit card, not monitored by their parents, because they do have a source of income to pay that. A student who has no job does not get that credit card. And as we've talked about earlier with co-signing, there is then an option for that student to get that credit card. And if the parent's co-signing, I would hope, or at least I know my father would demand some type of status update as we went along.
Right. The gentleman's time has expired.
Thank you for
Ms.
your
Biggert.
Yeah. Thank you, Madam Chairman. Mr. Thurman, in your written testimony, you say that these cards are not tailored in any way to be financially beneficial for students. For the large portion of students who really do use their cards responsibly, isn't there really, in fact, a tremendous benefit in the form of establishing credit history, and then they have an interest-free loan for each and every month.
That's correct, Mrs. Biggert. That's true. They have an interest-free loan each and every month in terms of the credit card in the first 6 months. Then you get the 15 to 19% actual APR. And what I meant when I said that it's not targeted towards students in any specific beneficial way is there's nothing that a student gains from signing up for a credit card that my father doesn't gain from signing up for a credit card in terms of benefits.
Yeah. Well, should there be any difference? And isn't it with a credit card and a young person starting out with a card, they're going to have a really low limit?
Sure, they're going to have a really low limit.
And doesn't that really, affect whether they would need to have a parent or anybody? Because that really is risk-based pricing, isn't it? Because let's say, as I recall, when my kids first started getting them, they were really low, like $500 or something, and they realized that they don't go very far with that. And that if they learn that lesson right then they balance whether they're going to have an overdraft or not.
That's true, and if I may take that example of a $500 limit, and then also use Mr. Clayton's statistical analysis that of total student consumers of credit cards, only about 37% are carrying an average. They don't pay off every month, and on average that balance is $452. So let's just assume on the low end they have a 15% APR. Now I have to admit, I got a C in finite math for business, so you might want to check the math. But if I start in the fall semester and I spend $452 on textbooks, and I'm a full-time student, so I don't have a source of income, and I've got a 15% APR, by the time I finish that year in May, which is when I can go get my summer job, that $452, which was under the $500 limit, has gone up to $1,380. That's not including the over-limit fees, the late payment fees that I might incur.
But you're assuming that you're only going to make the minimum payment.
Actually, I'm suggesting that I have no funds with which to make the payment.
Then you shouldn't have a card.
Very good point.
But do you really think that it's aren't we making it then harder for students to learn about and obtain credit? I mean,
I think if we take the narrow vision of quite simply saying no credit cards for students, yes, definitely. Mr. Clayton has a fantastic point. Students need credit cards, especially when our federal and state systems are failing them in terms of paying for higher education. But what we have talked about here in our discussion is a much broader scope of ideas, talking about co-signers, talking about making sure certain
But it's going to be the same thing, that if a student has got $452 that they put on their card the first month and then they don't have the money to pay it back, it's useless.
It's exactly, and if they didn't have the money to pay it, that means they would have had to report a zero average income, which right now gets me a credit card. But if we're talking about actual same standards for students as we have for people who work, for example, in a Ford Motor plant, I'm sorry, I'm from Detroit originally, I got to plug the name. If we're talking about the same standards, then that student doesn't get the credit card without the cosigner. If there's a cosigner, then there's someone else involved who does have some sort of income. Otherwise, the credit card wouldn't have arrived in that student's
Well, I don't think that their parents would cosign it if they knew that their child was not going to be able to pay it off. I mean, you would assume that they're sending money to somebody's in college or they're working part-time and they're going to build some funds, because a credit card is for a loan. It's not for just, a piece of plastic that they can charge with. And that's part of the problem, is some of these kids never realize that.
I would suggest two things, Mrs. Biggert. First of all, that when we start talking about our students' educations and financing it, that I'm very reluctant to make any assumptions, especially about family financing. And second, that a credit card is not at all a loan. A loan is a loan. And a credit card is a high-interest way to take care of, hopefully, temporary financial needs. But that's not how it's being used due to the circumstances surrounding our higher education system.
Well, I think we have a little difference in the definition of what a credit card is, because it is an unsecured loan. Okay, I'll yield back.
I thank the gentlelady for her questions. I thank all of my colleagues for their interest and their input, and the panelists. We appreciate it. The chair notes that some members may have additional questions for this panel, which they may wish to submit in writing. Without objection, the hearing record will remain open for 30 days for members to submit written questions to these witnesses and to place their responses in the record. And the hearing is adjourned. We thank everyone. Thank you.